The intellectual framework of a truly legendary investor, it often starts not just with brilliance, but with spectacular candor. Before we really dive into the ideas today, let's kick off with a story. It just perfectly illustrates this guy's independent thinking, his, well, legendary ability to just cut through the noise. Okay, picture this. It's 1985. Warren Buffett's acquiring Scott Fetzer. Now, an investment bank, they'd been hired before to sell the company, right? Charged this massive $2.5 million fee and totally failed. Didn't find a buyer. So Buffett, he swoops in and makes the deal himself. And the lead banker, probably feeling a bit awkward about that huge fee for literally zero results, he graciously offers Buffett this big, comprehensive book they prepared on the company.
And this is where Munger steps in.
Oh, yeah. Buffett's longtime partner, Charlie Munger. Doesn't miss a beat. His response to the banker offering the book.
I'll give you $2.5 million not to read it.
Huh. That is just... It's perfect, isn't it? It totally encapsulates his whole philosophy, avoid the needless complexity, see the wasted effort for what it is, and just refuse to play along with the usual high-fee financial song and dance.
Exactly. That kind of unconventional, surgical, cut-to-the-chase thinking that's really the heart of our discussion today. So welcome, everyone, to Book Talk Finance. We are diving deep into the essence of Charlie Munger, mainly through the lens of the book Charlie Munger, The Complete Investor. It's written by Tren Griffin, published by Columbia University Press. And Griffin apparently wrote this book because, well, Munger's ideas, brilliant as they are, were kind of scattered. They'd never really been pulled together into one, cohesive, usable, unified theory. So the book's goal is to give you an understandable framework for how Munger thinks, how he synthesizes knowledge, basically teaching you how to think a bit more like him.
And you really don't need more proof of Munger's, frankly, transformative impact on Berkshire Hathaway than Warren Buffett himself. He said it many times. 1 + 1 with Charlie and me certainly adds up to more than 2.
Yeah.
But, while his success is obviously amazing, the real value, and the book gets into this, isn't just his raw intellect. It's how he manages his own emotions, his psychology. He's incredibly disciplined about avoiding those psychological traps that, let's be honest, derail almost everyone else in the market.
Yeah, let's unpack the man himself for a second, because his personality really seems central to his whole approach. People constantly call him unrestrained. Like, he just says exactly what's on his mind, doesn't really care about tact or, social niceties sometimes.
Mm-hmm.
But that candor, it's powerful, right? Because he can just instantly point out when the emperor isn't wearing any clothes, saves him, and anyone listening, probably years of wasted effort.
And he's incredibly self-aware about it, too. He actually warns people not to just blindly copy his personality. He sort of feels his life was maybe too focused on improving his own mind, and that his peculiarities, like his famous irreverence, well, they might not make you the most popular person. He apparently once said something like, I may be remembered as a wise ass, whereas Buffett, he thought, would be remembered as a teacher.
Huh. But maybe a wise ass who is a teacher in his own way. Because Munger fundamentally is a teacher, and a really effective one, I think. He seems to live by this idea that the best thing a human being can do is help another human being know more.
Absolutely. And the way he does it, the mechanism, is actually startlingly simple when you boil it down. His core habit, his foundation, is basically, I observe what works and what doesn't and why. He really believes that learning from other people's successes and failures, which is why he famously reads hundreds and hundreds of biographies, is just the fastest way to get smarter and wiser without having to go through the pain yourself.
It really is no wonder his kids apparently describe him as a book with legs sticking out.
Yeah, that's a great image.
That dedication, that constant self-improvement, it's key. And it comes from a pretty disciplined background, actually. Just, the quick sketch. Omaha native, studied mathematics at Michigan, was a meteorologist in World War II, even got into Harvard Law without an undergrad degree, formed a top law firm, but then walked away, left law to invest full-time.
And the results, well, they speak for themselves, don't they?
Well, they really do. His investment partnership between 1962 and 1975 returned almost 20% a year. Now, compare that to the Dow Jones over the same period, less than 5%. We're talking a 15-point annual outperformance for over a decade.
Wow.
That takes more than just being smart.
Right.
That means you are actively, consistently avoiding the big mistakes everyone else is making.
And that kind of consistency, it wasn't built on some secret, complex formula. It was really built on the bedrock of Ben Graham's value investing system. Munger always stressed that Graham designed it to be, well, efficient. Simple enough, he thought, that anybody could use it. It's all about steering clear of unnecessary, confusing complexity.
Right. Reminds me of that old joke, NASA spends millions developing a pen that writes in zero gravity, upside down, whatever. The Russians.
Used a pencil.
Exactly. Use a pencil. That's the kind of, like, inherent clarity Munger seems to aim for.
Yeah, and Munger had a great quote for that kind of beautiful simplicity. Take a simple idea and take it seriously. Investing, he'd say, is simple, but it's not easy. That's the crucial difference, isn't it? And we need to keep coming back to that.
Okay, so let's lay out those core principles. Munger believed these 4 pillars of Graham value investing will, quote, never be obsolete. First, treat a share of stock like what it actually is. Proportional ownership of the underlying business. You own a piece of the company.
Not just a ticker symbol flashing on a screen.
Second, always buy at a significant discount to its intrinsic value. That's where your crucial margin of safety comes from.
Okay, let's pause there for a sec. Intrinsic value. That sounds like the tricky part, doesn't it? How does someone even begin to figure that out? It's not like it's printed anywhere.
No, absolutely. And that's where the work comes in. It's an estimate, right? An estimate of all the cash the business is likely to generate in the future, discounted back to what it's worth today.
So it's inherently uncertain. There's judgment involved.
Exactly. And because you know your estimate won't be perfect, that's why the margin of safety principle 2 is so vital. It's your buffer. Munger basically says if you figure something's worth $1, but you only pay 70 cents for it, that 30-cent cushion protects you when, inevitably, your forecast is a bit off.
Got it. Your airbag, essentially.
Right. Okay, principle 3. Make Mr. Market, the market's mood swings, its bipolar nature. Make him your servant, not your master. Use his irrationality to your advantage. Don't get swept up in it.
Easier said than done, but crucial.
And fourth, and this might be the hardest, you have to be rational, objective, and totally dispassionate. Keep your emotions out of it.
So the principles themselves, they sound simple enough on paper, but you hinted at it, the implementation, especially figuring out intrinsic value and maintaining that dispassion, that's where it becomes an art, wouldn't you say? Not just a science.
Definitely.
Success really demands the right kind of emotional and psychological setup, plus the sheer willingness to do the hard work, the digging required to even make a reasonable estimate of that value. You can't just, follow a checklist and expect great results. You have to earn it.
Okay, so Graham provides the foundation. But now we get to Munger's big contribution, the core framework the book really emphasizes. His multidisciplinary mental models. This is what Griffin argues turns a value investor into the complete investor.
Right. Munger realized, apparently quite early on, that you just can't solve complex problems, especially in business or investing, using tools from only one narrow field, like just finance or just accounting. You know the saying, if your only tool is a hammer, everything looks like a nail? Yep. Munger actively sought out the big, powerful ideas, these mental models from everywhere. Physics, biology, history, psychology, engineering, you name it.
So for someone listening, what does that actually mean in practice? Give us an example. How does a model from, say, psychology help you avoid an investing mistake?
Well, the classic one Munger talks about all the time is the psychology of incentives, or maybe, more accurately, the perverse effects of incentives. He argues that if you really want to understand why someone or some company is behaving a certain way, you have to figure out what's incentivizing them. Like if a brokerage firm's advisors are incentivized mainly by commissions on trades or by selling high-fee products, well, guess what they're likely to do, regardless of what's actually best for you.
Right. Follow the money, basically. Look at the system.
Exactly. Look at the system and see where the incentives are likely to lead behavior potentially astray. He applies that everywhere.
And it's the combination of these models, isn't it?
Yeah.
That's where the real power comes from. When you see multiple models, maybe from psychology, economics, maybe even physics, all pointing towards the same outcome.
That's what he calls the Lollapalooza effect, a confluence, a cluster of factors all pushing in the same direction, creating this massive result, good or bad. And you can only really spot those Lollapaloozas if you step outside the narrow confines of traditional finance thinking.
Which leads us right back to Munger's passion for simplicity, which maybe paradoxically seems connected to this complex web of models, but it's really about strategic focus, isn't it?
It is. He and Buffett both firmly believe that, quote, simplicity has a way of improving performance through enabling us to better understand what we are doing. Their approach is almost surgical. Focus intensely on the decisions that seem relatively easy, the ones where the odds are clearly in your favor, and just actively avoid the hard ones. It's about consciously tuning out folly, as he puts it, ignoring the unimportant stuff so your mind doesn't get cluttered.
And to maintain that focus, To avoid getting dragged into those hard or foolish areas, he uses this really practical, almost ruthless filter. The three baskets. You've got your in basket, your out basket, and your too tough basket.
And most things, for Munger, go straight into out or too tough.
Right. He says if something is too hard, we move on to something else. That in basket, the yes pile, is incredibly small.
Right.
Because you need what he calls a special insight for something to qualify.
Which sounds efficient, but let me push back a little. Couldn't calling something too tough just be a convenient way to, I don't know, rationalize ignorance? Or maybe even avoid doing the really hard work? How do you know when you've dug deep enough versus just giving up too early?
That's a really fair question. I think Munger's answer would be it's not about laziness, it's about profound self-knowledge, knowing your limits.
Oh.
He constantly references people like Confucius or Socrates, the idea that real knowledge is knowing the extent of one's ignorance. He's always assessing his own circle of competence. If you don't genuinely have an edge, some reason to believe you understand this investment better than the average smart person looking at it, then it belongs in the too tough basket, no matter how tempting the potential upside looks. It's a defense mechanism against your own limitations.
That makes sense. It's about intellectual honesty.
Yeah, and he uses this great analogy. Think of a professional tightrope walker, someone who survives doing that for 20 years. They survive only because he knows exactly what he knows and what he doesn't know. He's practiced that self-awareness intensely because one mistake, one misjudgment of his limits, and well, it's over.
Wow. Okay.
Munger insists that grand value investing isn't about showing off how smart you are. It's about systematically doing things that are unlikely to result in a big mistake.
And speaking of avoiding mistakes, that brings us perfectly to one of Munger's absolute core strategies: inversion. Thinking problems through backward. Focusing not on achieving brilliance, but just on consistently avoiding stupidity.
He famously said, didn't he? It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent.
It's such a powerful idea. Inversion means you actively think about what you don't want to happen, what you want to avoid. So you ask yourself those critical questions. Okay, what's the flip side here? What could go wrong that I haven't considered? If you're looking at buying a company, instead of just asking, how could this be a huge success, you invert it. You ask, what are all the ways this could fail? What are the paths to ruin too much debt, bad management, disruptive technology, and how certain am I that this company can avoid those?
It seems so simple, but it cuts through so much emotional baggage, doesn't it? Instead of getting hyped up about the potential upside, you systematically try to rule out the big downside risks first. As Munger put it, knowing what you don't know is often more useful than being brilliant.
And this philosophy, this focus on avoiding stupidity, it ties directly into probably the most challenging aspect of this whole approach for most people: temperament. And here's a really crucial point, one that trips up so many investors and leads them to abandon the strategy. Graham value investing is, by its very nature, intentionally designed to underperform in a roaring bull market.
Yo, okay, say that again. That's a big one. Intentionally designed to underperform when things are going great.
Yes, you absolutely must accept periods of short-term underperformance relative to the market indices. Think about it. If your core strategy is to only buy assets when they're available at a significant discount to their intrinsic value, what happens when the entire market gets really expensive, when everything's bid up?
You don't find much to buy.
Exactly. You'll be holding more cash, you won't be participating fully in the rally, and you will lag behind the benchmarks. It's inevitable.
So the goal isn't to beat the market every year.
No, the goal is superior absolute performance over the long run. The actual amount of wealth you accumulate, not just relative performance against some index in the short term. You achieve that better long-term result precisely by giving up some of the upside during the frothy periods. That discipline allows you to outperform significantly when the market inevitably goes flat or down, and everyone else is losing their heads. The famous investor Seth Klarman put it well: most investors are primarily oriented toward return and pay little attention to risk. Value investors invert that. They focus intensely on risk first.
That willingness to look wrong, to feel like you're missing out in the short term, that psychological pain, that's the real hurdle, isn't it? It takes a specific kind of temperament. This focus is so counterintuitive. Munger and others often use these funny stories to drive it home, like the talking frog story.
Yes, the talking frog. It's perfect for this. So the story goes, an investor is walking in a park, sees a frog sitting on a log. The frog pipes up, says he's actually a stock speculator under an evil spell.
Okay.
And the spell can only be broken if an investor kisses him. So the investor immediately scoops up the frog and pops him in her purse. The frog's muffled voice comes out, "Hey, what are you doing? Aren't you going to kiss me?" And the investor replies, "Absolutely not. You're worth a lot more to me as a talking frog than as another stock speculator."
Okay, I get it. The lesson is blunt. If you can't handle that short-term underperformance, if you're constantly tempted to chase the latest hot trend like the speculator frog, then, well, Graham, value investing just isn't for you. It's not your game.
Right. And this approach fundamentally recognizes the zero-sum nature of the market after costs. Munger called them the croupier's costs, the fees, the commissions, the trading friction.
Now, for someone to win, especially after those costs, someone else has to lose.
Pretty much. And for a Graham investor, the market's irrationality, it's folly. That's precisely their opportunity. Munger put it starkly. For a security to be mispriced, someone else must be a damn fool.
Wow.
And because the level of collective damn foolishness in the market ebbs and flows, opportunities don't come along steadily. They arrive, as he said, in a lumpy fashion. Sometimes you wait a long time.
So Munger's advice is?
Be patient. Be incredibly patient. Wait for the fat pitch, the obvious bet where the odds are heavily stacked in your favor. He calls them pitches, with no called strikes in investing. You don't have to swing at everything. But when that truly great opportunity finally appears, bet big.
This whole framework, though, as we've kind of circled around, it really hinges on developing almost a trained response, doesn't it? It requires overcoming some really deeply ingrained human behaviors that usually lead to poor decisions in investing. That emotional hurdle seems massive.
It is massive. It requires something akin to the old Greek philosophical ideal of ataraxia, perfect peace of mind, total imperturbability, the ability to stay completely calm and unaffected by the market's wild swings. Honestly, very few people actually succeed because they just don't have that innate temperament or they haven't cultivated it through intense discipline. This, by the way, is why truly good financial planners can be worth their weight in gold. Not necessarily for picking stocks, but for helping investors keep their own emotional and psychological dysfunctions under control.
Preventing the big mistakes.
Exactly, preventing the panic selling or the euphoric buying at the worst possible times.
You know what's really fascinating, though, is Munger's own explanation for why these ideas, which are simple, logical, and demonstrably successful over the long term, why haven't they spread more widely? Why isn't everyone doing this?
Yeah, his take on that is quite provocative.
He basically blames professional bias against simplicity, right? He said something like, the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say.
Ouch. But you can see his point, can't you? If the best advice is often do less, be patient, buy simple index funds, how does a complex financial industry justify its high fees and intricate products?
Right. The complexity often benefits the seller, the institution, far more than the buyer, the actual investor. It obscures things, makes the advisor seem essential.
It's like the ultimate cynical inversion, isn't it? The complexity in modern finance often isn't there to improve results. It's there to justify costs and create dependence.
Which brings us right around to Munger's very practical, very blunt advice for the vast majority of people who, let's face it, aren't going to dedicate their lives to this kind of intense intellectual and emotional work. His advice.
Just buy a no-load index fund. Simple as that.
Yeah.
Now, he acknowledges that for the tiny minority, the top maybe 3 or 4% of investors, the Mungers, the Buffetts, the true masters, sticking only to index funds, is actually a provably false path to maximizing their potential. They can do better. But for everyone else, it's the smartest, most reliable approach. And Buffett pointed out the beautiful paradox here. When dumb money finally acknowledges its limitations and chooses the simple, low-cost index path, it ceases to be dumb.
It's all about knowing your limits, knowing yourself.
Precisely.
That focus on simplicity as an antidote to sort of professional obfuscation.
Yeah.
Munger captured it perfectly with that fishing tackle story, didn't he?
Oh, the lures, yeah.
Right. He's visiting a fishing tackle shop, sees these crazy lures, bright purple, garish green. He asks a seller, "My God, do fish really go for these?" And the seller's deadpan reply.
Mister, I don't sell to fish.
Huh. It says it all.
Yeah.
The fancy, complex stuff often appeals to the buyer's psychology, not the actual goal.
So the takeaway for you, listening to all this, is maybe twofold. First, the work required to truly emulate Munger is immense, and the necessary temperament is incredibly rare. You have to cultivate a mindset that is just profoundly different from the crowd's.
Yeah, I remember reading that Columbia Business School professor, Bruce Greenwald, described the successful value investor as needing to be a certain kind of mutant, completely different in their orientation to what's an attractive investment for the rest of the market.
A mutant. That's a strong word, but maybe not far off. So the real question we want to leave you mulling over as you think about Munger's incredible framework is this. Do you have the right stuff? Do you have the discipline, the patience, the emotional detachment required to potentially be that kind of mutant investor?
That is definitely a challenging, but also, I think, a really motivating thought to end on. Thanks so much for joining us for this book talk today. Make sure you subscribe to our channel for more discussions and talks like this one. We look forward to seeing you next time.